Welcome to the Commercial Real Estate Show, your source for market intelligence, forecast, and strategies. Hello, I'm Michael Bull. Thanks for being with us. We have an incredible show for you today, a cool show, I'd say. We're going to talk about the restaurant industry. So we're going to look at how restaurants performed in 2015 and what to expect moving forward. We're also going to look at some of the factors impacting the restaurant industry. And then we'll also share some locations and operational tips. Please welcome my first guest. It's Darren Tristano. He is president of Technomics, and he's headquartered in Chicago. They provide a 360-degree view of the restaurant industry. Darren, thanks for joining us.
Thanks for having me today.
Well, we appreciate being with you here on Skype, using technology here. So how did restaurants perform in 2015?
Well, as a first look, restaurants performed well last year. Now, we still consider the industry to be relatively a mixed bag, where there are those that are performing very well and those that are struggling, and in some cases declining, closing, and losing sales. So overall last year, we did a little bit better than the year before, so we're on a positive trend. We always like to talk about what's ahead. So when we look at 2016, we expect sales to remain relatively moderate, about 4 to 5%, which is good news, but even better news for restaurants, the costs of commodities are starting to come down. So that means that if sales are maintained year over year, but the costs are a little bit lower, it'll be a little bit more profitable for restaurant owners this year.
Well, that's good news. So a 45% increase in sales is what you're expecting for 2016, and how does that compare to, say historic numbers?
Well, historically, it's been around that 5% range. Now, we saw some tremendous growth from the period that ended, just began after 9/11, really through the recession in 2008, and we saw very strong growth rates, 6, 7, 8%. And then obviously the recession hit and we saw a tumble, a few years of very difficult times. In fact, we're just now recovering and getting back to a level of sales similar to where we were just before the recession. So overall, I'd say we're getting closer to more historical numbers and recognizing that you typically see 2.5%, 3% food inflation price increase. So when we're looking at 4 to 5%, it's about 2% on a real basis, which is what's important to most operators. So overall, we're getting to a point where things are trending nicely. We expect it to continue, and hopefully we don't hit any bumps in the road ahead.
Okay, and those are top line numbers, right? So what do you expect moving forward for profitability, for kind of the bottom line for the restaurants?
Well, the restaurant industry is an interesting area. Typically, we talk about a 5% margin, which is not a lot of money. Unfortunately, because of the labor rates and minimum wage increases that are expected, it's getting more difficult for operators to maintain their margins. Now, there are restaurants that are doing 20 to 25% returns. Those would be brands that include the Five Guys, Chipotle, Starbucks. So these are brands that are doing very, very well. And then there are others that are struggling at the bottom, that are seeing a lot more competition. So really, when you look at the market, you have to look at the segment that a restaurant performs in. So as we look at the industry today, talking about winners and losers, surprisingly, fast food has rebounded nicely. They're doing very well. Those and the kind of family-style restaurants that you see, IHOP, Denny's, primarily because gas prices are low, lower to middle-income consumers have more money in their pocket, which they typically spend and want to indulge because they've got a lot of pent-up demand. So what's struggled over the years, fast food and family-style restaurants are actually rebounded nicely and are performing very well. Now, we've seen fast casual and fine dining continuing to perform well, primarily because they really serve an affluent consumer who's more insulated from some of the economic conditions. So those two areas, although relatively small, are doing very well. And then we have casual dining, which has become a very low performing segment of the industry. You have restaurants like Applebee's and Chili's that aren't expanding. They're trying to do well. They're focusing on value, which deteriorates margin. And these restaurants, very large, are struggling to fill the seats day in and day out. So we're still seeing a little bit of growth there, but typically around the same as price inflation. So as we look at the industry, the restaurants that serve the more affluent consumer doing really well. Those that are now down into the middle and lower income groups starting to perform, and casual dining struggling at lunch, kind of stuck in the middle between great and poor quality food. So they're just not at a level that consumers are seeing them as a place to go frequently.
We're talking with Darren Tristano. He's president of Technomics about the restaurant industry. And Darren, it's the commercial real estate show, so I'm curious about the rent-to-revenue ratios for the restaurant industry. What do you see those for the typical various types of restaurants, and how is that trending? Have you seen any changes there?
Well, there's really nothing typical about rent to revenue. Depending on if you're a very large restaurant that might do banquet versus a small pizza operator that out of a very small space can do a lot of revenues. So I think the more important question is, how does the commercial real estate industry look at restaurants? Today, incredibly competitive. Those brands that are expanding are looking for A locations. A lot of these locations are currently occupied, so there is somewhat of an arm wrestle or a struggle for them, which means that rents are going to continue to go up quite nicely, and these restaurants are going to fight for the key spaces because we just don't have enough of them. As we talk to operators, real estate has become one of the hardest parts of their strategy. Finding A locations, oftentimes settling for B locations. So I think when it comes down to the rent versus the revenue, I think you have to be in a good, strong position to evaluate that. But ultimately, it also comes down to the level of sales you're going to receive and how that's going to impact the operating expenses, and ultimately the ability for an operator owner to stay in business, to continue to pay their rent, and to be viable over a 5 or 10 year period to really absorb those tenant improvement allowances.
Yeah, well said. I agree. Location is so key to restaurants. And so we're talking with Darren Tristano. He's with Technomics about the restaurant industry. And one of the things that my viewers and listeners are curious about is technology, and technology is sort of impacting every industry. Is there a certain type of technology that's really having an impact, maybe that's moving the needle in the restaurant industry?
Well, I think when we look at the restaurant industry, they're somewhat of a late adopter to technology. It's still a very manual, kind of hands-on type of industry. And with hospitality, there's a caution that we don't want to see technology replacing hospitality. So ultimately, the technology should enhance the customer experience. When it comes down to it, certainly tablets at the table have become very popular. Now, a couple of the reasons why consumers indicate they like them are that they can pay the check when they want. They have the convenience. And to be able to strike a credit card at the table, sign and leave, it's a nice way to enhance the experience. Now, also there's gaming. So a lot of venues like a Buffalo Wild Wings, Chili's, even Olive Garden have created gaming opportunities to keep the kids busy. So for me, going to dinner with my family was a special occasion. It was about interacting. But today, parents need a break from their kids. So giving them the ability to play games at the table, even though most kids have their own tablets, has become somewhat essential to some of the restaurants. But overall, I think social media delivery, where we see a lot of third parties doing more delivery, where you are using them to go to the store, buy the meal, and deliver it, becoming mobile engaged has become very important. And then ultimately social media. We just finally saw McDonald's come out with a new app that connects their younger consumers to their brand. It allows them to communicate better, to offer specials, to inform them, and even in many cases to ask questions from the consumer to find out what they're thinking, what they'd like to see, and how they're doing as a brand. So I think overall, the tabletops that allow you to check out of a restaurant, look at menus, the gaming for the kids, and the ability for younger consumers to be able to connect to a restaurant brand and interact with them has become ways that technology has certainly helped the restaurant operator.
Well, that makes a lot of sense, and you got to keep those kids busy, right? Keep them quiet.
Sure do.
We're short on the break, Darren, but you also mentioned some of the restaurants being smaller than they used to be. What's the trend there?
Well, I think the trend is it's easier to control your costs than it is to control your revenue at times. So the opportunity to reduce your footprint, your square footage, has allowed a lot of restaurants to move down into smaller spaces that might be a little bit tighter, a little more tough if you're doing catering, but because consumers are starting to eat more outside the restaurant, that means in your car with one hand on the wheel and one hand on a sandwich. It means taking it back to work or taking it home. So oftentimes there are less consumers who are coming in to dine at the restaurant. They're on the go, they come in, they grab their food, they want to leave and go eat somewhere else. So reducing the platform so that you have less dine-in square footage allows you to reduce rent and become ideally more profitable. And certainly that's going to help operators today.
Yeah, well, that makes sense. Well, Darren, thanks for joining us. We appreciate you being on the show.
Thank you for having me.
Well, stay tuned. We're going to take a short break, and when we come back, we're going to have some major operators in Studio One to share some tips and strategies. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate asset and occupancy solutions. Visit bullrealty.com. CCIM Institute, commercial real estate's global standard for professional achievement. Visit ccim.com/CRE show. Xceligent, providing verified commercial real estate information across the United States. Visit xceligent.com.